So in this video and in a couple of the subsequent ones, we're going to talk about the dangers of globalization. But before I do that, I want to be clear that while we're going to spend a lot of time talking about the dangers of globalization, we're not going to spend a ton of time talking about the benefits of globalization, because I think they're kind of obvious, right? They come from the theory of comparative advantage, this idea that trade and exchange creates increased economic efficiency. It increases the overall wealth on the planet, particularly for us as consumers. It allows us to have much cheaper goods. It allows companies, actors, and so on to diversify economically, so that if investments in one country are going well or are going badly, they may have investments in another country that are going well, and so it helps balance risk. Of course, it gives us all a greater access to a greater range of goods and services. Think about just the produce aisle at your local grocery store. You can get produce really that's shipped in from all over the world. It doesn't matter what time of the year it is in some cold part of the United States. You can get blueberries, because if you're not getting blueberries from Maine, you're getting blueberries from Mexico or from Chile. So you can get your antioxidants all year round. If we want coffee, we can get our coffee from Kenya, from Nicaragua, or from Sumatra, and on and on and on, right? And not to mention the fact that if we're lucky and have a little bit of spare money, we can jump on a plane, pretty cheaply travel to all these places, and easily, take money out of a cash machine in pretty much any country in the world. It's really amazing. So enough of the benefits of globalization. Let's get to the bad stuff. The biggest dangers are crisis and contagion. And there's really two separate issues here. One is the way in which globalization might start or might facilitate an economic crisis. And then the other is, to the extent that there is an economic problem in one country, to what extent does it facilitate the spread of crisis from one country to another? So first, exchange rate crisis. And there's a lot of words on this slide. And I want to stress that if this is confusing you, it's also laid out in the textbook, and you can go through it at your own pace there. But to begin with, right, the possibility for exchange rate crises come from globalization, but they come from a really awesome thing about globalization, which is countries, no matter how poor a country is these days, there's potential access to global financial markets. Because even if you're in a poor country somewhere, there are rich people in some other country who have money that they want to invest if they can get a good return on their investment. And so in contrast to 30 or 40 years ago, poor countries are not limited in the amount of capital they can access. So that's a huge benefit. Foreign investors can invest in your economy. That decreases the cost you have to pay to borrow money and to get investment. And that's good for the investors as well. They can diversify their portfolio, get an increased return, right? And overall, economists will say it means that capital is invested more efficiently, because it can go wherever in the world that it can be invested most effectively. So everything's hunky-dory until the value of the currency falls in the country that's borrowed a lot of money, or where the actors there have borrowed a lot of money, or even just where there's a lot of international money invested in the stock market, right? So as the exchange rate declines, as let's just talk about the Russian ruble, as each ruble is worth fewer dollars, investors, the assets that are priced in rubles are also therefore worth less money, because when you sell them, you can get fewer dollars in return for those rubles. So if the exchange rate goes down, the assets priced in that currency automatically go down as well in terms of dollars. And so what do? So you're going to sell assets that are priced in Russian rubles. That, of course, as you sell an asset, the more people selling an asset, the more the prices go down. And so you can get in this cycle. In many cases, a new equilibrium is reached. That is to say, everything goes down and then it stabilizes. But in some cases, the decline in the value of a currency becomes this sort of self-reinforcing cycle, and it can go way, 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 way down before somebody or something steps in to stop it. But in the meantime, right, billions of dollars of value can be destroyed, and a country's economy can really be sent into a very dramatic crisis that causes people to lose their jobs, struggle to buy food and things like this, right? When the value of the currency collapses, everybody in the country becomes poorer to the extent that they're using that currency to buy goods that are imported from abroad. A debt crisis is pretty similar to an exchange rate crisis, and in fact often combines with an exchange rate crisis. There's a big market out there, again, to borrow money. The loans are generally made in US dollars or sometimes in euros, so-called hard currencies. And if you borrow money in US dollars, you have to pay it back in US dollars or euros. We'll just stick with dollars. Which is all well and good, but when you borrow money in dollars, you convert it into your local currency and get a certain amount of your local currency, and you invest that in your economy, or you invest that in your business, or you do whatever you do with it. If subsequently to that, your exchange rate declines, right, you may have borrowed enough dollars to get you 1,000 rubles. It may now take 1,500 or 2,000 rubles to pay back the same number of dollars. Right, so when you've borrowed money and the exchange rate declines, it now takes more of your own currency than before to make the debt payment in dollars. And this leads to two bad things. Again, the same thing that I pointed to on the previous slide. Investors sell the currency, and that pushes the exchange rate down even further, and the problem gets worse. But it's also the case that as the exchange rate goes down and it becomes harder for you to repay the dollars you owe, lenders say, oh, the risk is elevated a little bit, so we're going to charge a higher interest rate. And so as debt is financed, or the term often used is rolled over, right? If you owed $1,000, or it's more likely to be $1 billion, right? If your country owed $1 billion at 2%, and now you're going to essentially roll over the loan because it becomes due, so you're borrowing money from this person so you can pay off the loan to that person. If the previous loan was at 2%, the new one might be now at 3%, which means the exact same debt as before now requires higher debt payments, and of course you're making them with a currency that's worth less. And so at some point, the real definition of a debt crisis, which is in the book, is when it gets to the point where either investors don't think that a country can any longer make the payments, or a country says, you know what, this is too painful, we're just not going to do it anymore. Because the more debt, the more currency has to be collected to pay those debts off, right? Either taxes have to be raised, or other things that the government was going to spend money on have to be neglected, and that's pretty painful. So this is just the illustration from the textbook, and the only big point to get at here is this idea that it's cyclical, right? And this is a key thing to understand about all kinds of economic crises, right? In standard economics, when one thing changes, everything else adjusts, and then it stops. And one of the problems with crises is that things go around in this cycle, and sometimes that cycle reinforces itself and keeps going rather than hitting a new equilibrium. Okay, so that's how things get bad. That's where crisis comes from. Now I want to talk about how they spread from one country to the next. One is a simple one. If investors in some country, let's just say the United States, right, we've invested a bunch of money in Russia, and now we lose money because the Russian economy's gone into the tank because they had an exchange rate crisis or a debt crisis. So now we've lost a bunch of money in Russia, and in order to make up for that, we sell some of our assets here in the United States, right? So that now starts pushing down the price of assets here, and we can have our own downward cycle. Or we simply have less money to spend because we lost a bunch of money, and that takes demand out of the U.S. economy, which again can begin to push the U.S. into recession. In other words, now a problem for country A is a problem for country B. This gets particularly bad when some big financial institution in country B, like in the United States, has invested so much money in another country that when those investments go south, then that company is itself not able to pay its debt anymore. So now you've got a big investment bank in New York unable to pay its debts to other big investment banks in New York. And so now they're in trouble. And you get this ripple effect through an economy where one company potentially going bust can therefore create bunches of problems for other companies that have lent money to them, and so on and so forth. This goes throughout the economy. And the example of this is a U.S. firm called Long-Term Capital Management, which had invested a lot of money in the Russian bond market. And when the Russian bond market collapsed in 1998, all of a sudden, this company lost a great deal of money. Well, it had borrowed that money from other Wall Street firms. And so its problem now became a problem for all of these other firms. And basically, the Federal Reserve Bank had to step in to create this succession of crises from rippling through the entire U.S. Financial sector. A second time, a kind of contagion is actually simpler, and it's just fear. If things go bad in one country, investors look to limit their exposures in similar countries, and they withdraw investments. And then so that then can mean if we look at what happened in country A and we say, holy smokes, let's pull our money out of country B just to be safe. Now we've accidentally imposed a crisis on country B, where there was not one before. And in fact, that's what started the financial crisis in Russia in 1998, was that in 1997, there was a financial crisis in Southeast Asia that really began in Thailand. And as that sort of created problems, people who invested a lot of money in Russia said, boy, Russia looks kind of like Thailand. Let's yank our money out. And when that happened, Russia then immediately was in a currency crisis and a debt crisis. And it had very far-reaching political repercussions in the sense that this was one of the reasons why Russians were so angry about the reform in their country after the end of the Cold War, and why Vladimir Putin was able to come to power. So, big picture, globalization brings both opportunity and danger, and the question is, how do we mitigate the dangers so that we can gain the benefits of globalization, even if we debate exactly what those benefits are?